Buying a house can often be the single biggest investment you'll ever make, an investment regularly made possible by a mortgage. But the question is, what is a mortgage? A mortgage is a loan from a bank or other institution that allows you to purchase a house with a down payment and to pay the remaining balance over time. To understand how a mortgage works, let's look at a young couple named Mike and Kim. They've found a house that they want to buy for $400,000. They've saved $70,000 as a down payment, of which $20,000 are personal savings, $10,000 in RRSPs, and $40,000 as a gift from their parents to get started in life. The remaining $330,000 is the amount required in a mortgage to purchase the house. A mortgage lender will advance Mike and Kim the $330,000 in exchange for regular principal and interest payments over an agreed-upon time frame. Since they're purchasing their home with less than a 20% down payment, the lender will also have them purchase CMHC insurance. This insurance protects the lender in case Mike and Kim are unable to meet their commitment to repay the mortgage on schedule. Over time, Mike and Kim will build equity in their home by paying down the mortgage loan. As these payments are made, the lender will have less and less stake in their property, while Mike and Kim will gain more and more equity. Now, let's take a look at variable rate versus fixed rate mortgages. All mortgages include a rate of interest or return for the lender, but as a home buyer, you must choose between a fixed rate or a variable rate mortgage. This choice will depend on your financial flexibility and your appetite for financial risk. A fixed-rate mortgage commits you to a standardized payment schedule that stays constant over the term of the mortgage, usually 5 years to start. With a fixed-rate mortgage, your payment never changes, making it easier to budget household expenses each month. By contrast, a variable-rate mortgage means your payments will fluctuate with the prime interest rate, which is set by the Bank of Canada. For example, a rate might be indicated at prime minus 1% or prime plus 2%. Although your interest rate in relation to prime will remain the same, the payments you make will fluctuate in relation to changes of the prime interest rate. People might choose variable rate mortgages as they're generally offered at a lower interest rate than fixed rate mortgages, but they do come with heightened risk since the prime interest rate can always increase. When selecting the mortgage that's right for you, there's another important consideration: time. The amortization period is the time a homeowner takes to pay off their entire mortgage. This time frame can be up to 25 years. A longer amortization period is helpful for families who want to lower their initial payments. However, a longer amortization period also causes the homeowner to pay more interest on the life of the mortgage. In contrast, the term of a mortgage is the period of time a homeowner agrees to the rules, conditions, and interest rate of the mortgage loan. Mortgage terms can range from 6 months to 10 years, but the average term is 5 years in Canada. For years, home buyers would look to their local bank for a mortgage loan. Today, however, many home buyers are relying on independent mortgage brokers with access to lending options from several institutions to get the best available rates. Independent mortgage brokers have access to many different lenders, including the big banks, which means home buyers will be guaranteed the best available rates. Mortgage brokers' services are also free, as they're paid a commission from the lender. A competitive mortgage broker will have access to interest rates that would be otherwise unavailable to the average home buyer as a result of the volume of business the mortgage broker engages in with each lender. Lending institutions will offer discounts to mortgage brokers, which they in turn pass along to their clients, making for a win-win situation. Once you've selected a mortgage lender, you're ready to start the application process. If you already own a home, you can apply for a mortgage to buy your new home. And if you're a first-time home buyer, you can apply for a pre-approval as you begin the hunt for your dream home. In determining your eligibility for a mortgage, lenders will generally consider 3 basic factors: your credit rating, the amount of your down payment, and your annual salary. Lenders will examine your credit rating to determine how good you've been at paying debts on time. They'll consider things like car loans, credit card balances, and personal loans to determine your eligibility for a mortgage. With respect to down payment, the more equity you have invested in your house, the less risk you pose to the lender. And finally, the combined salary of co-applicants like Mike and Kim help lenders determine the maximum value of a mortgage they can afford. Now that you understand the way mortgages work, it's time to find out how much you could be saving. Find us online at centummortgagechoice.com and let our team help you with the right mortgage to fit your unique needs at the best rate available.